name is Linda Bloemen, Senior Consultant at KPMG. This module will focus on the Shareholder Rights Directive II. The Shareholder Rights Directive entered into force in 2007. Its main function was to grant meeting rights for shareholders of listed companies across the European Union. A revised version of the directive has been issued in 2017. And this directive has been implemented in Dutch law the 1st of December 2019, and some parts will be implemented the 3rd of September 2020. The Shareholder Rights Directive II has been introduced due to the Action Plan on European Company Law and Corporate Governance from the European Commission. And this directive has been introduced because, according to the European Commission, shareholders were not requiring accountability from their board members regarding their decisions and actions. And this is caused by insufficient shareholder involvement and lack of transparency. With the amendments contained in the Shareholders Directive II, the European Union sets out to further strengthen the position of shareholders. So, the Shareholder Rights Directive II has been established to create more shareholder involvement in the governance of listed companies, and it creates possibilities to oversee the remuneration policy and transactions with related parties. The requirements in the directive apply to listed entities of which the shares are listed on a European stock exchange admitted for trading on a regulated market, such as Philips and Unilever. Intermediaries within the custody chain, insofar they offer services to shareholders or other intermediaries with respect to the shares of listed entities, such as the Giro. Also to institutional investors, insofar they invest in shares that are admitted to trading on a regulated market. And this means that the requirements do not apply in case investors invest in a multilateral trading facility or an organized trading facility. Asset managers, insofar they act on behalf of investors that invest in shares that are admitted to trading on a regulated market. And to proxy advisors, insofar they offer services to shareholders of listed entities. And proxy advisors are voting advice bureaus that perform research, provide advice, and make recommendations regarding the voting behavior on general meetings of shareholders. What are the main requirements of the Shareholder Rights Directive II? The first requirement is to transfer or comply with requests related to the identification of shareholders. Shares of issuers are regularly being held through complex cross-border custody chains. These chains start with a central institution that is seated in a member state where the shares are admitted for trading on a regulated market. The central institution keeps the shares in a depot and has one or more parties that are affiliated with it and who are partners in the depot. Such parties, banks, investment institutions, or other central institutions also maintain a deposit in which either other banks, investment firms, or central institutions, either private or legal person act as beneficial owner. These chains make contact between the issuer and the shareholder more difficult, especially when the chain is cross-border. An issuer only oversees the shares that are registered with the central institution, except for the cases in which shareholders are required to report themselves because they are holding 3% of the shares. For information on the remaining shareholders, the issuer has to depend on the communication through the custody chain. The Shareholder Rights Directive II aims to harmonize the communication through the custody chain. Issuers in member state of which the shares are permitted to the regulated market may identify the shareholders by intermediary parties in the custody chain. those intermediary parties have to transfer requests for identification. Intermediary parties that receive such requests may not comply with the request if the shareholder owns less than 0.5% of the issued capital. Intermediaries in the custody chain have to provide information relevant for the exercising of shareholder rights to the shareholder and should ensure that the shareholder can communicate the information to the issuer. This, for example, includes the result of the vote that they made. Non-compliance with these requirements is considered to be an economic crime, and adherence of these requirements can be requested by the shareholder or the issuer through the civil court. The second requirement is disclosure of the engagement policies and alignment of the investment strategy. The Shareholder Rights Directive II requires that institutional investors and asset managers have an engagement policy and to publish this policy, including an explanation of the investment strategy. Such disclosure increases investor awareness and the capacity of beneficial owners, such as future retirees, to make better investment decisions, to promote the dialogue between companies and their shareholders, and to increase shareholder engagement and enhance their accountability to stakeholders in society. In the explanation of the investment strategy, the institutional investor has to disclose the alignment of the investment strategy and the duration of the liabilities, including the contribution to long and mid-term performances of the portfolio. This engagement policy also includes an explanation of the dialogues with the company, the exercising of voting rights and other rights related to the shares, cooperation with other shareholders, communication with other relevant parties in the company, and the management of conflict of interest related to their involvement. Institutional investors and asset managers have to publish an explanation of how the engagement policy has been implemented on an annual basis. This also includes the matter of the voting in the meeting of shareholders and the voting behavior and explanation of the most important votes and the use of proxy advisors. In case institutional investors and asset managers don't comply with publishing an engagement policy, they should explain this on their website. Another requirement is the disclosure of the remuneration policy with respect to board members and supervisory board members. A remuneration policy is one of the key instruments for companies to align their interests with those of their board members. Therefore, it is important that shareholders have the opportunity to comment on the company's remuneration policy. In order to ensure that shareholders have effective control over the remuneration policy, they should be entitled to vote in a binding or advisory manner. And therefore, the Shareholder Rights Directive II requires listed companies to have a remuneration policy that should be adopted by the general meeting of shareholders. Such remuneration policy should, amongst others, include an explanation of the contribution of the investment strategy, long-term interests, sustainability of the company, and a description of the fixed and variable remuneration and other bonuses. The remuneration policy should be disclosed on the website of the company after the voting and including the date and the voting results. When the board members and supervisory board members of a listed company fail to disclose the remuneration policy of the company, they can be held liable on the basis of improper performance of duty. The final requirement is disclosure of material transactions with related parties. The Shareholder Rights Directive II requires listed companies to disclose material transactions with related parties. That scheme is intended to ensure adequate safeguards for the protection of interests of companies and shareholders if the company enters into transactions with related parties. These transactions can cause damage for companies and their shareholders by appropriating the value belonging to the company by related parties. Greater transparency regarding related parties may prevent companies from entering into and submitting questionable transactions. This protects the interests of the company and the minority stakeholders, and for example enables minority stakeholders to take legal action against such transactions. Listed companies, amongst others, have to disclose the type of relationship with the company, the name of the related party, and the date and value of the transaction. Related parties, amongst others, include shareholders, creditors, and other stakeholders. And material transactions are transactions with inside information or transactions between the company and natural or legal persons that own at least 10% of the shares of the company, or transactions with supervisory board members or board members in case of conflict of interest. Transactions that are in line with the normal business activities and in accordance with market conditions are not considered to be material transactions and should be considered at arm's length. However, there should be an internal procedure that is followed periodically to determine this. Material transactions with subsidiaries are excluded. Material transactions should be approved at the general meeting of shareholders or by the supervisory board. Failure to comply with the decision-making rules makes a decision of the board voidable. What is the impact of the Shareholder Rights Directive on investors? The Shareholder Rights Directive II creates an obligation for institutional investors to be more transparent about investment strategies, their engagement policy, and the implementation thereof. Thus, they will have to develop and publicly disclose a policy on shareholder engagement or explain why they have chosen not to do so. The policy on shareholder engagement will have to describe how institutional investors and asset managers integrate shareholder engagement in their investment strategy, which different engagement activities they choose to carry out, and how they do so. The Shareholder Rights Directive II requires institutional investors to publicly disclose how their investment strategy is consistent with the profile and duration of their liabilities, as well as how it contributes to the medium and long-term financial and non-financial performance of their portfolio. If they make use of asset managers, details of this arrangement should also be publicly disclosed, in particular in respect of the alignment between the manager's strategy and the investor's long-term liabilities. In addition, the Shareholder Rights Directive II creates an obligation for institutional investors to facilitate the transmission of cross-border information across investment chain to ease the identification of shareholders. Finally, the Shareholder Rights Directive creates benefits for investors because it increases the level and quality of engagement of asset owners and asset managers with their investee companies on contentious issues. The Shareholder Rights Directive II creates insight in the results and activities of investee companies due to the disclosure of material transactions and provides insights in the ultimate shareholder of investee companies due to the identification rules. And finally, the Shareholder Rights Directive II increases insight into executive pay and corporate performance of companies by voting rights on remuneration policies. The second part of this module will focus on the Netherlands Stewardship Code. The Netherlands Stewardship Code, hereafter will be referred to as the Code, has been published by Eumedion mid-2018 and entered into force as per 1 January 2019. Eumedion is an organization whose members are institutional investors, and it promotes the interests of institutional investors in view of corporate governance and sustainability. Society at large expects that both Dutch and non-Dutch asset owners and managers that hold the overwhelming majority of the shares in Dutch listed companies and manage other people's and institutions' money, take their responsibility in playing an active role in promoting good corporate governance and sustainability practices at Dutch listed investee companies. The code provides further guidance on behavior that is expected from asset owners and asset managers as shareholders of Dutch listed investee companies. The code explains how asset owners, these are institutional investors, and asset managers can meet their stewardship responsibilities in a way that contributes to the long-term value creation by Dutch listed investee companies and consequently to the long-term risk-adjusted returns on their investments. The code also makes asset owners more accountable to their beneficiaries and asset managers more accountable to their clients. Furthermore, it accommodates companies in identifying which of its investors are committed to vote in an informed manner and are prepared to enter into a constructive dialogue. The code should be read in conjunction with applicable legislation and regulations. What are the 11 principles of the code? The code provides a clear-cut, state-of-the-art set of 11 principles for stewardship by asset owners and asset managers towards Dutch-listed investee companies. Asset owners and asset managers of Dutch-listed investee companies are encouraged to commit to the principles of this code. The first principle is having a stewardship policy. Asset owners and asset managers have a stewardship policy that describes how they integrate stewardship towards Dutch-listed investee companies in their investment strategy. The stewardship policy should be aimed at preserving and enhancing value for the beneficiaries and/or clients, and should promote the long-term value creation at Dutch-listed investee companies. The stewardship policy should at least include the matters described in the principles of this code and should be publicly disclosed on the asset owners and asset managers website. Asset owners and asset managers shall at least once a year publicly disclose and publicly report on their website how they have implemented their stewardship policy. Asset owners shall also report if and how they have integrated that policy into their arrangement with their asset managers. Preference is given to the term stewardship policy instead of engagement policy, because that is used in the revised Shareholder Rights Directive. The second principle of this code is monitoring on material issues. Asset owners and asset managers monitor their Dutch-listed investee companies on material issues, including but not limited to the company's business model for creating long-term value, the company's strategy, performance and risk and opportunities, the capital structure, social and environmental impacts, and corporate governance and corporate actions, such as mergers and acquisitions. Material issues are those matters that are likely to significantly affect the company's ability to create long-term value. The third principle is enter into dialogues with executive or supervisory board directors. Asset owners and asset managers are prepared to enter into dialogue with the executive and/or supervisory directors of the Dutch-listed investee companies, and they are prepared to escalate their stewardship activities in case issues remain unresolved, where appropriate and at their discretion. In the event that an asset owner or asset manager enters into a dialogue with a Dutch-listed investee company on certain issues outside the context of the general meeting, the asset owner or asset manager will disclose its full equity holding, long and short, at the request of that company. The fourth principle is cooperate with other shareholders. Asset owners and asset managers cooperate with other shareholders in exercising stewardship activities towards Dutch-listed investee companies where appropriate and at their discretion. The fifth principle is communicate with relevant stakeholders. Asset owners and asset managers communicate with relevant stakeholders of Dutch listed investee companies where appropriate and at their discretion. The sixth principle is identify, manage, and remedy potential conflicts of interest. Asset owners and asset managers identify, manage, and remedy actual and potential conflicts of interest in relation to their stewardship activities towards Dutch listed investee companies. Asset owners and asset managers publicly disclose on their website a conflict of interest policy in relation to their stewardship activities. The seventh principle is exercise voting rights in an informed manner. Asset owners and asset managers exercise their voting rights and other rights attached to shares in Dutch listed investee companies in an informed manner. They publicly disclose on their website, at least once every quarter, how they voted their shares in Dutch listed investee companies at an individual company level and per voting item, and at least annually a general description of their voting behavior at general meetings of Dutch listed investee companies, and an explanation of the most significant votes. In the event that the asset owner or asset manager casts an against or withhold vote on a management proposal, he should explain the reasons for this voting behavior to the company's board, either proactively or at the request of the company. The eighth principle is publicly disclose voting policy and how they use proxy research. Asset owners and asset managers publicly disclose their voting policy and at least annually if and how they use proxy research and or voting services. Asset owners and asset managers that use proxy research and or voting services ensure that their votes are cast in line with their own voting policy. The ninth principle is consult the company's board prior to requesting an extraordinary general meeting or tabling a shareholder resolution. Asset owners and asset managers that consider exercising their right to submit a request for governing an extraordinary general meeting or for tabling a shareholder resolution at a general meeting of a Dutch listed investee company should have consulted the company's board prior to exercising this right. The 10th principle is be present or represented at a general meeting if a resolution has been put on the agenda. If a resolution proposed by an asset owner or asset manager has been put on the agenda of a general meeting of a Dutch listed investee company, the asset owner or asset manager should be present or represented at that meeting in order to explain the resolution and, if necessary, answer questions about it. The last principle is abstain from voting if their short position in the company is larger than their long position. Asset owners and asset managers will abstain from voting if their short position in a Dutch listed investee company in question is larger than their long position. Asset owners and asset managers should recall their lent shares before the voting record date for a general meeting of Dutch listed investee company if the agenda for the general meeting contains one or more significant matters. Asset owners and asset managers should not borrow or lend shares for the primary purpose of exercising voting rights on these shares. Asset owners or asset managers who have lent shares will take reasonable steps to discourage that those shares are not borrowed for the primary purpose of exercising voting rights. What is the impact of the Netherlands Stewardship Code? As from book year 2019 onwards, asset owners and asset managers are expected to report on their compliance with the principles and disclose specific information that is requested in the principles. While the Code's principles are principally focused on stewardship towards Dutch listed investee companies, the principles can also be applied to non-Dutch listed investee companies as appropriate. It's neither the asset owners nor asset managers' role to manage the companies in which they invest. They do, however, play a role in monitoring the boards of those companies, and that is why they need to gain understanding of how the boards fulfill their responsibilities. The stewardship role of asset owners and asset managers includes the casting of informed votes at general meetings and the monitoring of and the engagement with listed companies on aspects related to strategy, the performance and risk and opportunities of the company, the capital structure, the social and environmental impact, and corporate governance. Engagement is conducting a meaningful dialogue with listed companies, amongst others related to issues that are subject to the votes of general meetings. This can help to build trust and develop mutual understanding that supports the objective of long-term value creation by companies. To advance the goal of engagement, asset owners and asset managers are, where appropriate and at their discretion, also expected to cooperate with other shareholders and to communicate with other stakeholders of the company.